These are the three most popular account types that you can invest in. I'm Mark Palmer, ex-financial professional, here to help you build wealth. You can follow me on Twitter or Instagram at MarkPWealth. Before we get started, I want to make sure that you understand that this is not financial advice, it's financial education. If you want specific advice to your situation, go find a financial advisor. Also, I'd really appreciate if you hit that like button on this video. Really helps out my channel, simple for you to do, win-win. When it comes to investing, there are many different account types that you can use. Each account type has its own pros and cons, but the main differences are when you can withdraw your funds without a penalty and how your funds are taxed. Another difference for each account type is how much money you can contribute into the account. Now, I'm not a tax professional, but I can at least give you the guidelines as they stand at the time of me filming this video. One common misconception about investment account types is people often think that you earn a certain return based on the account type you're invested in. So for example, people think, oh, I have an IRA that earns this percent return because it's an IRA, or I have a 401k that earns a certain return because it's a 401k. What's wrong about this thinking is you actually are making the return on the investments held within the account. The IRA, the 401k, whatever your account type is just a bucket, and whatever you put inside of the bucket is what's earning the return. Theoretically, you could just hold cash inside each of these account types, and it really wouldn't make much of a return at all. But it's the investments that you choose to invest in within the accounts that earn the return that you hear people talk about. In another video, we'll go over the different investments that you can hold within each account type. But today we're going to just focus on the account types themselves because they have their own parameters that you should know about before getting started. The first account type we'll discuss is a non-retirement brokerage account, also known as a taxable brokerage account. Non-retirement brokerage accounts allow you to deposit as much money as you'd like, and when you're ready, you can withdraw however much money is in your account without paying a penalty, no matter your age. For any investments in these accounts that you make a profit on, the profit is taxable. So that's the amount in addition to how much you initially invested. So for example, if you invest $100 and it turns into $150, $50 is taxable on that investment. On the flip side, any investments you make in these accounts that end up losing money, the loss becomes tax deductible. So for example, if you deposit $100 and you invest it into something and it turns into just $50, well, you now have $50 that you can write off as a tax deduction. The rate at which you are taxed for these gains really depends on your personal situation, so I won't get into deep detail on that, but it is worth looking into before you open one of these accounts or before you make a sale in one of these accounts. As the law currently stands, you aren't taxed on gains and losses until you actually sell the investment within the account. So if you've made $50 on one of the investments within your account, but you have not yet sold it, you are not paying taxes on that $50 unless you do decide to sell it. It could still go up and down, but at this time, you do not owe any taxes because you have not yet sold the position, and what they call you have not yet realized the gains. They are currently unrealized if you have not sold. Tax laws could change at any time, so make sure that you look into the current laws before you decide to make an investment related decision based on the tax implications. These non-retirement or taxable brokerage accounts are the most flexible when it comes to how much you can deposit and how soon you can take out funds without a penalty. On the flip side, these accounts have the least amount of tax advantages. As far as how much you are taxed on the gains in these accounts, it's very situational based, and it depends on how long you've held the position. All I'm going to go over today is any position that you held for over a year is currently labeled as a long-term holding. Therefore, if you sell it for a gain, it will be a long-term gain versus something that you held for less than a year. If you were to sell it for a gain, it will be labeled as a short-term gain. As of this current time and filming this video, long-term gains are taxed at a better tax rate for you, the investor, than short-term gains. How much those are specifically depends on you, your income, many other factors So look into that for your own situation. That was kind of a lot at once. So just to clarify a couple things here, when I say positions that you held, that's like a stock or a mutual fund, something that you're invested in within this non-retirement brokerage account. And when I say being taxed at a better tax rate, that means being taxed at a lower tax rate, something that you as the investor would most likely prefer in these situations. One last thing on these taxable or non-retirement brokerage accounts, you typically have a lot of flexibility on what you can invest in within. There's tons of different stocks and mutual funds out there. It's not usually a set list like some other account types may give you. Let's move on to the next account type. This one is called an IRA. Whether it's traditional IRA or Roth IRA, they have a lot of the same parameters, and we will go over the slight difference between the two account types as well. As of the filming of this video, either type of IRA has a contribution limit, the limit on how much you can deposit, for 1 year of $6,000, unless you are age 50 or older, when in that instance you can deposit up to $7,000 per year. You cannot make withdrawals from these accounts until you're age 59 and a half, unless you want to pay a penalty on that money. There are some exceptions on that rule, but you'll want to consult with a tax advisor before getting into that. So what is the point of these accounts then? The point of traditional and Roth IRAs is the tax advantages that they come with. For a traditional IRA, you deposit pre-tax dollars, meaning whatever you contribute into the account is tax deductible. So if you make a contribution on funds that you have already paid taxes on into a traditional IRA, you then get to deduct that amount from your taxable income. Then, when you are in retirement age or over age 59 and a half, you can withdraw from your traditional IRA and you will pay taxes on the amount you have withdrawn, regardless of how much was a gain. Essentially, for a traditional IRA, it's avoid tax now, pay tax later. For a Roth IRA, it's the exact opposite. You contribute money that was already taxed. Then, when you decide to withdraw in retirement age, you don't pay any taxes on the money you withdraw from your Roth IRA. Your contributions to a Roth IRA are not tax deductible. So for a Roth IRA, it's pay tax now, avoid tax later. One other caveat for a Roth IRA is there is an income limit in order to contribute to a Roth IRA. As of the filming of this video, if you are a single tax filer with an adjusted gross income of $129,000 or more, or a married filing jointly couple making $204,000 or more total adjusted gross income, you are not eligible for a Roth IRA. There are workarounds such as a backdoor Roth IRA. You would want to consult with a tax advisor before doing something like this. One more piece on IRAs, both traditional and Roth. Again, you have a lot of flexibility on what you can invest in within these accounts. The next account type I go over isn't always that case. The next account type we'll go over is 401ks and 403bs, and there's something within these that I really like. Speaking of like, please like this video if you haven't already. If you're feeling generous, please subscribe to my channel as well. It really helps me out a lot, so thank you. 401ks and 403bs operate very similarly. They're essentially one and the same. Just depends on your employer on which they offer, whether it's a 401k or a 403b. These account types are offered by your employer, and they allow you to contribute directly into the account from your paycheck. They typically have a set list of different investments you can choose from to hold within the account, so they're a little more restrictive than the other account types we've gone over, but that isn't always the case. It really is case by case based on your employer. Like IRAs, 401ks and 403bs typically have a traditional or a Roth offering based on your employer. Most would offer either of those options for you to choose from, and based on traditional or Roth, they have similar tax advantages. So for a traditional 401k, you are going to avoid paying tax now, and then you will pay the tax later when you withdraw the funds. And with a Roth 403b, you will pay the tax now and then not have to pay tax later when you withdraw the funds. These accounts also have similar restrictions to the IRA accounts, such as when you are not yet age 59 and a half, you would have to pay a penalty in order to make withdrawals from these accounts. They also restrict the amount that you can contribute into the accounts, although there is a much higher limit on these account types. As of the filming of this video, you can contribute up to $20,500 into a 401k or 403b, and if you are age 50 or older, there is an additional $6,500 that you can contribute into the account in addition to that $20,500. This is sort of like a catch-up limit instead of the under age 50 where you're only able to do $20,500. One great thing about the 401ks and 403bs is that it automates your investments. So instead of needing to receive your paycheck and then go and contribute it or invest it into another account, this essentially makes that process automatic, and you don't even see that money because it gets deducted from your paycheck before it reaches your bank account. Another thing that I really like about these accounts, some employers offer what's called an employer match on your contributions into your 401k or 403b. An employer match is a contribution that your employer makes into your 401k or 403b, and it's with their own money. They're not taking from your paycheck. They are making this contribution out of their own money into your retirement account. The reason it's called a match is because they usually require you as the employee to invest a certain amount in order for them to match that amount. For example, if your employer does a 5% match, dollar for dollar, that would mean if you contribute 5% of your paycheck into your retirement account, they will also contribute that same dollar amount into your retirement account from their own money. So in this example, if your paycheck is $1,000 and you're contributing 5% to your 401k, you'll have $50 deducted from your paycheck to go into your 401k, and your employer will also add $50 on top of that to go into your 401k, but you'll still only have to take out $50 from your paycheck, and they will add that $50 from their own money. Not every employer offers an employer match on 401k or 403b contributions, and the ones that do all have their own certain ways that they do it. It's not always dollar for dollar. It's not always 5%. So be sure to look into how your employer offers their match if they offer one. Additionally, employer matches are not always available until you have worked at a company for a certain number of years. Oftentimes, they will let you start receiving the employer match on your contributions, but the money won't technically be yours until you've worked there for a certain time period. This is called vesting. Your money is vested once you have earned the employer match amount. Sometimes this happens all at once, taking you from 0% vested to 100% vested, all at one certain work anniversary. Sometimes it happens in increments, such as 20% each year for 5 years. Regardless, the employer funds that they match for you are not yours until they are vested. The funds that you contribute from your paycheck are yours, regardless of how vested your employer match is. If your employer does offer a match, it usually is a good idea to contribute the total amount that will at least give you the full match that they're willing to give. This is essentially free money for you, or like giving yourself a raise, because you're still getting paid the same amount. You're taking your money from your paycheck and contributing it to your retirement account. It's still yours, and then they're giving extra on top of that you would not have gotten if you didn't contribute that amount. You can still contribute more than the employer match amount as long as you don't go over the contribution limits that we already discussed. All right, let's recap. The 3 most popular investment account types are non-retirement brokerage accounts, traditional or Roth IRAs, and 401ks or 403bs. Non-retirement brokerage accounts have full flexibility on contributions and withdrawals without penalty. You also have a full range of access of different investments to hold within these accounts. But there are no tax advantages for these accounts, and you are taxed on the gains within. Traditional and Roth IRAs do have contribution limits, and most withdrawals before age 59 and a half would be penalized. Traditional IRAs allow you to avoid tax now and pay tax when you withdraw. Roth IRAs have you pay tax now and avoid tax when you withdraw. Traditional and Roth IRAs typically have a full range of investment options available for you. 401ks and 403bs also have contribution limits, and most withdrawals also would be penalized before age 59 and a half. And again, with these, Traditional 401ks or 403bs have you avoid tax now and pay tax later, whereas Roth 401ks or Roth 403bs have you pay tax now and avoid tax later when you withdraw the funds. But one great thing that some 401ks and 403bs offer is an employer match, which allows you to boost your contributions into the account. Everyone's situation is different, and not everyone is going to use all of these different account types. I personally have a taxable or non-retirement brokerage account. I have a Roth IRA, and I have a Roth 401k. I also have a traditional IRA that I rolled over from a traditional 401k that I used to hold at my old employer. Lots of different account types out there for you to choose from. Make sure you're educated on both your situation and the options you have available to you before you decide to open a certain account. And again, if you're not sure what you want to do, it's always helpful to work with a tax professional or a financial advisor. They can help you a lot. I am neither of those things, so don't take what I've told you in this video as advice. It is purely education. You have to go and make your own decisions from there, or consult with someone who is a professional that can help you out. That's all I've got for today on different investment account types. There will be a future video that goes over the different investments that you can hold within these accounts. But for now, you've learned a lot. I hope that this helps you out, and I also really appreciate you taking the time to watch this video. If you have any questions, feel free to ask them in the comments below, or reach out to me on Twitter or Instagram at MarkPWealth. Please like this video and subscribe to my channel if you haven't already, and I look forward to seeing you next time.